Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar on asset allocation, incorporating data-driven indicators. We're very pleased to have with us this afternoon two sponsors. Our first sponsor, Covenant Capital, is an independent wealth manager based out of Singapore. Capital Market Service, Covenant Capital also holds Capital Markets Services license issued and regulated by the Monetary Authority of Singapore. Founded in 2016 with the back to basics and stewardship focused on wealth management services to high net worth individuals and families. Investment philosophy of Covenant Capital is built upon three pillars of alignment of interest to clients, offering investment expertise, taking an open architecture approach to access products and solutions globally tailored to clients and their best interests. Now, also, we do have with us this afternoon Ned Davis Research, which was founded in 1980. Ned Davis Research is a provider of independent, objective, and risk-aware analysis of the financial markets and global economic data. NDR approach combines both fundamental and technical research to provide timely insights and ideas. NDR signals and indicators have indicated or impacted over 900 million US dollars in assets. So with that, I'd like to turn this over to my colleague Guillaume from the Interactive Broker office in Singapore. Now, Guillaume will be introducing our speakers here this afternoon. So please, Guillaume, back over to you.
Thank you very much, Cynthia, and thank you very much all for joining tonight. I'm Guillaume. I'm heading the sales in our new Singapore office, and it's my pleasure to present our guest panelists today. So we'll have Alejandra Grindal, who is the Senior International Economist for Ned Davis Research Group. She is the primary person in charge of the firm's global economic outlook, and she is responsible for identifying global economic trends and themes, particularly as they relate to development in equity, fixed income, commodity, and currency markets. In recent years, Alejandra has been particularly focused on global demographics and labor force trends, China economic transition, and Japan lost decade. She joined Ned Davis Research in 2006. We'll have also Josh Lay, a CFA, is the portfolio manager at Covenant Capital and is managing global equity mandate. He is also the investment committee. He is part of the investment committee that looks at cross-asset strategies. He's graduated from Master of Financial Engineering program, and Josh applies extensively macro data and indicators into his top-down process for both equity and cross-asset allocation. We have also Brian Sanborn, CFA, Senior Vice President of Wealth Management Solutions at Ned Davis Research. He oversees all investment model and signal delivery partnerships. Brian chairs NDR's index committee consisting of NDR strategists, research analysts, and product specialists. The index committee reviews and approves new investment models as well as enhancement to existing models. He has been with NDR since 2004. So now I pass on, to Alejandra.
Great. Thank you so much, Guillaume, for the introduction, and thank you, everybody, for joining us today. I am going to begin the presentation with NDR's global economic outlook, with a focus a little bit on the Chinese and U.S. economies, just because they're the two largest, and then ultimately take this all together and discuss what it means for markets. I'll then pass the call on to Josh, who will talk about how these indicators that we build into our view at NDR can actually be put into implementation. Due to COVID-19, we are now seeing the sharpest global recession since at least the global financial crisis, and possibly even the worst since the Great Depression in the 1930s. The following charts, many of the ones I'll show today, will show the damage that we've seen in the global economy, despite still being in the early stages of this. I'm trying to maneuver the slides. Okay, good. Despite just being in the early stages of this process. So this first chart that I'm showing right here, this is our NDR global recession probability model. It shows the probability that the global economy is in an OECD-defined global slowdown. As you can see in the chart, starting in mid-2018, the global economy had actually fallen into a sustained slowdown. It was a fairly modest one. By early this year, however, the probability had fallen out of the high-risk zone. We were seeing signs of easing trade tensions between the U.S. and China. We were seeing easier monetary policies around the world. But clearly, because of COVID-19, this recovery came to a crude and very abrupt halt. As you can see, the model surged 26 points to 93%. This is the largest monthly gain in our model in nearly 2 decades and the highest level in 8 months. And our analysis has found, because we'll take these macro indicators and we'll see what they mean for markets, our analysis has found that when this index is rising and in the high-risk recession zone, as it is right now, global equities tend to do worse on average. If you move on to this next chart, it's showing another early read of the pandemic's impact on the global economy. This is the manufacturing PMI. We have a reading for March. And whenever you have a PMI reading below 50, as we are right now, it's an indication of contraction in the manufacturing industry. And the chart here is showing essentially the deepest downturn since at least the global financial crisis. I'm not showing the services number in this particular chart, but it fared significantly worse, as you would assume, due to lockdowns and social distancing, which essentially kept people at home and engaging in any services. That indicator dropped a record 10.1 points to 37. This is just well below even what we saw during the global financial crisis and the lowest on record since data began in the late 90s. And this is particularly concerning because services really make up the majority of GDP of the world's largest economies. And this even includes China. And the downside is a lot of the activity lost, such as going to the movie theater, eating out, even going on vacation, that just can't be recuperated. You can't double up on that after the fact. So that's just a dead loss to the economy. This next chart that I'm showing here is showing the breadth of the economic downturn, sort of taking a technical indicator and applying it to the macroeconomy. And it's a really good measure of how broad-based the recession is. And as you would assume, the more widespread the economic contraction, the deeper the recession. So if you look at the top clip of the chart, this shows the percentage of all the PMIs around the world, so really good representation of the global economy, that have expanding manufacturing industries. And as you can see, less than 10%, so specifically 9.1% of the world's economies were showing manufacturing growth in March. This is the lowest, you can go back and you can see that right here. This is the lowest since the global financial crisis. And I think what's most astounding is how sharp that drop was. 2 months ago, more than half of the world's economies had expanding manufacturing industries. Now, fewer than 10%, so a very, very sharp fall. Services, again, I'm not showing it, but I wanted to just show you how stark of a fall we saw there. We have a breadth reading for that as well. In January, 100% of the world's PMIs had expanding services industries. In March, it fell to a record low 0%. Just shows you how quickly this happened. The global situation would have been a lot worse, say in March and maybe perhaps even in April, had it actually not been for China. Chinese production is reportedly getting back online, and you can actually see this in this chart right here. This is showing also the manufacturing PMI for China, the top clip, and then the services for the non-manufacturing PMI in the bottom clip. And you can really see that sharp rebound in activity where you saw these record low levels in February. And then as people started going back to work and lockdown started being eased, you see this big pickup in activity again for March. Some people ask, well, do you believe it? Well, we've got confirmation from the private sector PMI. It's also in line with recent improvements in mobility and shipping data. But even the Chinese Statistics Bureau says that the sharp jump in the index did not necessarily reflect a return to pre-COVID-19 levels. So it's not like they're getting back to those strong growth rates that they had before. It's just picking up the rebound in activity after the economy essentially came to a complete halt in February. Despite this pickup that we saw in March, we still estimate that the Chinese economy did contract in the first quarter from a year earlier. We'll get a read on that within the next 24 hours. China will be releasing the data, but if this is the case, this would be the first year-to-year contraction in the economy in over 30 years. So this is something very, very different. What we'll be watching going forward is with large parts of the world still on total or partial lockdown, we're seeing a few places starting to open up a little bit, but not to a large degree. It's just hard to fathom a sustained recovery in the Chinese economy, or at least returning to pre-COVID-19 levels anytime soon. This next chart right here is showing the Baltic Dry Index, and specifically sort of a measure of its seasonality. So the Baltic Dry Index, for those of you who aren't familiar, measures the price of shipping raw materials by sea. And what's kind of nice is essentially
Alejandra?
Yes.
Are you still speaking? Okay, I've lost audio.
Yes, I'm still speaking. Do you hear me?
You seem to be breaking up. Would you just go back and repeat from the beginning of this slide? Thanks.
Sure. Thank you. So this, so we'll go back one slide to the Baltic Dry Index slide. Yes, perfect. So this chart is showing the Baltic Dry Index. It's, for those of you who are familiar with what it is, it's a measure of the price of shipping raw materials by sea. What it essentially is, it's kind of a proxy for global demand for commodities. And what's nice about it is that it's reported daily. With China being a large buyer and producer of commodities, it's also a great guide to their economy. So if you, as you can see in this chart, this Baltic Dry Index tends to fall going into the Chinese Lunar New Year. Just shows you how much it's China driven as companies prepare for workers to go home for the holiday, and then they're off for about a week, and then ultimately the index tends to recover right after. But because of the lockdowns, you may recall they began around the Lunar New Year and then extended through February. The Baltic Dry Index actually failed to pick up after the week-long holiday. So you can see how it didn't follow the normal seasonal tendency. But what you're seeing right here is about a month later, the index did pick up after those stay-at-home rules were eased. And with, you know, and we are starting to see a recovery here. We'll just be watching it closely because, as I said, with the rest of the world now kind of now on lockdown and a few months behind China, we'll see how sustained it is. But for the time being, it has moved up. Now I wanted to just share a few quick thoughts on the U.S. economy. The U.S. economy was actually on relatively stronger footing at the end of 2019, again, because of the easier monetary policy, the easing of trade tensions. But there's no doubt the U.S. economy is in recession, a very bad one, as consumers really avoided social gathering, partly voluntarily, but also due to state-mandated lockdowns. And this has impacted so many sectors: retail, wholesale, education, leisure and hospitality, food services, manufacturing, mining. I mean, many, many sectors. All of those combined account for 30% of U.S. GDP. And as I'm showing right here, the weekly jobless claim numbers, which is usually a report that doesn't call a whole lot of attention. Oh my goodness, it really has over the past several weeks, and you can see why. Look at this number. In fact, over the past 4 weeks, initial jobless claims have totaled 17 million. I mean, you go back and you look at this historically, and this has never happened. It even makes the great financial crisis just look like a really small little bump over here. Overall, these gains, and we'll get a number actually within the next 15 minutes or so, these gains represent 10.5% of the labor force. And if, holding all that together, that would imply that the unemployment rate in April will likely approach 15%. So this does surpass what we saw during the global financial crisis. So very, very quick how this happened. On this next slide, I wanted to give an illustration of what these global economic slumps have meant for global equities, kind of tie the two together. And so what this chart right here is showing is the blue line or turquoise line is the MSCI All Country World Index, so a measure of global stocks. And then those vertical shaded lines are OECD-defined global slowdowns. And as you can see, pretty much all large drawdowns we've seen in global equities, going back, since the All Country World Index was, started being reported in the late 1980s, all of those large drawdowns in global equities have occurred in or around these OECD-defined global slowdowns. It just shows you how important the macro is. You'll also notice that the vast majority of the equity drawdown tends to occur after the recession has begun. So as long as you get that starting point pretty close, you'll be able to prevent a lot of downside. But the severity of the equity drawdown has depended on the severity of the economic downturn, which actually makes sense. So what you'll find is that deep or sinister global recessions, which we have found historically are ones that are coincided with U.S. recession, have been associated with much larger declines in global equities. So that helps to explain the large slump we saw right here, as well as 2008-09, which was also a pretty bad global recession, early 2000s, and even early 1990s right here. So it sort of shows you how important the macro is. So because of this, impact on markets, this impact on the economy, it's no surprise that policymakers around the world have responded to the crisis with extreme intensity. Just to start off with the global monetary response, it's been immense, it's been immediate, and it's already surpassing that of the global financial crisis. Central banks had several tools to enact policy. Part of, many of them they learned during the global financial crisis. And one of the biggest benefits of monetary policy is there's usually no implementation lag. You can just go out and make the changes as needed. So given the widespread reach of COVID-19, the global response has been some of the broadest by country that we've seen. And you can see it right here in this chart. So if you look at this chart right here, the bottom clip, the orange line, this is the share of the world central banks in easing cycles. It's essentially a percentage whose last rate change was a decrease, but it's kind of a proxy for what percentage are in easing cycles. And as you can see, the latest reading is at 98%. This is the high, this is pretty much every major. We have about 40 developed and emerging market central banks in this. This is the highest reading since October 2009. We also have a reading that shows the percent of central banks with record low rates, and it's at an all-time high of 60%. And, what essentially happened was central banks that had shied away from the zero bound in the past, Australia, Norway, New Zealand, they're now getting pretty close to that point. They were pretty quick to move to that. The other major move was quantitative easing. Several central banks not only opted to do quantitative easing for the first time, but also even buy corporate debt for the first time. The Fed went all out with unlimited QE. The ECB introduced an $800 billion bond buying program, reduced a lot of prior limitations, the capital key requirements, which would benefit the southern economies in the Eurozone, which tend to be more COVID-19 afflicted. The Bank of England went back to QE mode, and even countries, Australia, New Zealand, who hadn't even dabbled with quantitative easing in the past, joined the club this month. So combined, all of these purchases could surpass past trends. And as you can see just in this one chart in particular, whenever one would assume, but whenever monetary policy is broadly very accommodative, that's actually usually been a good sign for global equities. This next chart, I also just wanted to discuss the other side of support, and it's the fiscal side of things. And what this chart here is showing proposed and current fiscal stimulus in response to COVID-19 as a share of GDP, and we have it for a few different countries around the world. And one observation is that several countries have already enacted more fiscal boosts now than during the global financial crisis. And at least for the global financial crisis, we now have, it's in the past, so we see the cumulative effect. In this case, we could see even more. So, these countries are already surpassing, and we could potentially even see more. The most obvious standouts are in Europe, Germany, France, UK, enacting packages, whether it's direct spending as well as loan guarantees to small and medium-sized enterprises, totaling about 15% of GDP. The U.S. is providing also a very large stimulus package, about $2 trillion. We could see more. There's been talks of that, but even that alone amounts to nearly 10% of GDP. Stimulus is well targeted, includes health spending, direct checks to households, enhanced unemployment insurance, direct loans to businesses. And even at this point, it surpasses global financial crisis fiscal stimulus on an aggregate basis, as well as a share of GDP. One standout is China, with relatively less stimulus, particularly if you compare it to the global financial crisis. You could argue that their mega stimulus helped secure the global economic recovery we saw in 2009. Problem is that fiscal boost did create some consequences for the Chinese economy, including ballooning debt. So the Chinese government, is a little nervous about putting something really big out there. There's been a monetary response, but for the most part, the fiscal response has been a little more targeted. Some anonymous sources have said that if things get really bad, there could potentially be a large infrastructure package, but even the estimates of that don't look as large as what we saw during the global financial crisis. So I have focused on the economy. I have focused on the link to markets. I want to move on to the next slide because at NDR, when we're trying to identify turning points in the market, we also like to include technical indicators. They are often very good for timing. So they're not often, but always included in our process. As you can, I showed a few charts back, the market tends to peak around the beginning of global recessions, but the market does tend to bottom about 6 months before recession ends. So sometimes we like to look at a few other indicators to be able to identify those turning points. If we can, my goodness, very sensitive. Okay, so this next chart right here shows a few measures of equity market breadth. So if you look at this second clip right here, it's looking at the percentage of MSCI All-Country World Index stocks that are above their 50-day moving average. So this is a short-term breadth measure. This bottom clip right here is showing the percentage of MSCI All-Country World Index stocks that are above their 200-day moving average. So this is a measure of longer-term breadth. And often when we've carved out a bottom, the short-term breadth moves up, and then it's followed by the long-term breadth, which ultimately confirms the recovery. And as you can see in the performance box at the bottom of this chart, whenever both of these breadth measures are weak, which they are right now, it tends to not be a good condition for global equities. Conversely, when both breadth measures are fairly strong, it tends to be a positive condition for global equities. So it's kind of a good way to look at this technical indicator globally. And then this final chart I have here is showing global stocks and bonds relative to their 50 and 200-day moving averages. So these are in these bottom clips, and then the top clip is looking at the relative strength. So even though global stocks have rallied somewhat in the past month or so, the MSCI All-Country World Index does remain below its 50 and 200-day moving average. Global bonds actually are exceeding their 50 and 200-day moving average. So as a result, if you look at this top clip, the relative strength of stocks to bonds continues to look weak, which again is historically a bearish condition for equities. So with that framework in place and the review of all these various indicators, I would now like to pass the call on over to Josh.
Hi everyone, this is Josh from Capital. Thank you, Alejandra, for sharing with us your macro view and interesting indicators. But how to leverage on macro signals and indicators to optimize asset allocation process? And this is today's topic. I will go through with you our SAP, the systematic asset allocation product that Capital and Ned Davis Research has been working on. We all know that in investment, asset allocation is key. We all know that in investment, asset allocation is key to optimize your returns in the long run. However, how to apply data analytics and macro indicators into asset allocation process, and furthermore, what is the most efficient mode of execution? To answer these questions in SAP, we focus on these two areas: the systematic asset allocation and efficient execution by ETFs. Systematic asset allocation is a disciplined asset allocation process that's purely driven by data analytics and macro indicators without human intervention, without human emotion or biases in the investment process. And secondly, why ETFs? Because ETFs are low cost and very well diversified, very liquid instruments. And for this reason, this is also the most efficient mode of execution. And this is how we add value in SAP. Now, you could be asking how the SAP model works. SAP is constructed based on a two-tier systematic asset allocation process. And you know that equity and fixed income are the largest asset classes. And to determine the right allocation between equity and fixed income is very crucial for our investment process. So for that reason, our top priority is to come up with a split between equity and fixed income. And in this primary level, we use these 6 indicators, and some of them you have already heard from Alejandra. This is a combination, the good combination between fundamental indicators, the central bank policy index, the Baltic Dry Index, the PMI breadth, OECD composite leading indicator, and 2 technical momentum indicators. Those are equity and bond relative strength, or the percentage of countries above 50-day moving average. Let's say the outcome of this primary level to come out with 40% allocation into equity and 60% in fixed income. This is the outcome of the primary level. I would highlight one fundamental indicator here, the central bank policy indicator. We all hear this statement: don't fight the Fed. And this indicator in this particular environment extend this statement to one more level: don't fight the central banks. When the central banks are flooding the market with liquidity, don't go short the market, and then you should be in equity, and vice versa. When the central banks are tightening liquidity, you should reduce equity exposure. And you heard from Alejandra, one of the major difference between this current environment and the GFC in 2008 is this indicator, the central bank policy index. The central bank have been very active this time around to launch new QE programs, or to cut rates globally, or to provide liquidity. And for this reason, at the moment, this indicator still favors stocks over bonds. And I will go into one more momentum technical indicator, the equity and bond relative strength. The concept behind this indicator is you don't fight the tape. When momentum is in favor of stocks, the stock-bond ratio is gaining traction. You shouldn't be in bond. You should be more in equity and vice versa. At this moment, this indicator favor bonds over stock, as equity has lost momentum in the months of February and March. And in this slide, this is the framework to come out with our asset allocation between equity and fixed income. Okay, in this slide, we go into the secondary level of asset allocation. So for example, from the first primary level, you have 40% into equity, 60% in fixed income. And you might be wondering how this 40% in equity get distributed into each individual ETF in equity, and 60% in fixed income get distributed into fixed income ETFs. And you can see over here on the left-hand side, these are the indicators for equity ETF. The Z-score, momentum, relative strength index, or bow tie signal. And on the right-hand side, these are the indicators for fixed income. MACD, the moving average, and then the next one is distant from the exponential moving average, EMA, relative strength index, or bow tie indicator. I would highlight one indicator in equity, Z-score. This is a mean reversion indicator. So Z-score measures the deviation of year-on-year price change versus its historical range. And when the deviation is far from the average trend, the ETF tend to reverse back to the mean. And as a result of it, the model determines the direction of this ETF to whether increase or reduce its weight. And for fixed income, we zoom into this indicator, the distance from EMA, exponential moving averages. Some of you might be very familiar with this, with trading the EMA signal. And this indicator measures the distance or the strength of the price movement momentum versus its EMA range. And when the momentum is building up for a particular ETF on the long side, for example, this ETF will get higher weight in the model. Right. In the previous slides, I have shown you our allocation process that eventually come out with a weight that go into each individual ETF. You might be wondering and want to know more about these ETFs. On this slide, we show you the 13 ETFs that we use in this model. You have 6 equity ETF, 6 fixed income ETF, and lastly, 1 cash alternative ETF. 6 fixed equity ETF, you have very well diversified between in the US, for example, the SPY US large cap versus IJR, the US small cap ETF, or QQQ US growth ETF versus VIG, the US dividend and value ETF. And you also have the US versus the rest of the world, EFA, developed international equity ETF and emerging markets ETF. And fixed income ETF, 6 ETF, similarly also very well diversified. So you have TLT, the US long-term treasuries versus the SHY, the US short-term treasuries, and LQD, US investment grade versus JUNK, the US high-yield corporate ETF. And you have the US versus the rest of the world, EMB, emerging market bonds ETF, and BNDX, international treasury ETF. And lastly, you have MINT, a cash alternative ETF. Okay, in this slide, this is the outcome of our model, and it's also our current allocation. Equity 42% and bond 58%. Why 42% in bond in equity and bond 58%? You look at the table below, that show you the 6 primary level indicators at the moment. Right, you have the central bank policy, as I mentioned, still favors stock at the moment. PMI breadth still favors stocks. OECD composite still favors stocks. However, equity, bond, relative strength, percentage of country above 50-day moving average, these are the 2 technical and momentum indicators are currently favoring bonds. And Baltic Dry, the trade proxy, also favoring bonds at the moment. As a result, the primary level, bond received 58% and equity 42%. Now, if you look into individual ETF, you also can see that the model right now is pretty defensive. In equity, in fixed income, 58%, majority of the allocation go into treasuries, whether it's TLT, the US long-term treasury, or the SHY, the US short-term treasury, or BNDX, the international treasuries. And in equity, we largely allocated into US large cap, SPY, US large cap, QQQ large cap and growth in the US, and VIG large cap dividend. And I would end here and pass back to Brian to moderate the Q&A section.
Great. Thank you so much, Josh, and thank you to Alejandra for your prepared remarks. Just as a reminder to everyone on the call, you can ask questions via the questions panel on the GoToWebinar software. And we've already started to receive some questions. And so the first one is, it just ties into the current environment and comparing it to the global financial crisis, in particular 2008. So I guess, Alejandra, would you have some points on that from the macro side?
Sure, of course. Everyone hear me okay, hopefully. So the cause, one clear difference is that the cause of recession is very, very different. In 2008, it was caused primarily by a U.S. housing debt bubble that burst, while clearly this one's caused by a global pandemic. The collapse this time around, as I showed you in a lot of these previous charts, was just so fast and so intense, nothing like what we've seen before. Another big change, too, is the world's two largest emerging economies, which usually sort of help prop up global growth because they rarely contract. And I'm talking about China, India to some extent as well. They're likely to go into recession. So this is a really big change. On sort of a positive note, sort of different from 2008, which was sort of a point I alluded to also, was that the monetary and fiscal response this time around has been much bigger, and it's been much more broad-based. And I think another point that I didn't mention before is that it actually came very, very quickly, possibly because, usually fiscal responses can take some time, just because you're trying to get agreement. And, if you look at the 2008 crisis, there was a disagreement over who the bad guy was, but everybody can sort of get behind a virus as being the bad guy. So just sort of giving you an example, the U.S., we right now sort of assume that the U.S. recession began in March, and U.S. Congress approved a package that exact same month. To compare to 2008, the fiscal stimulus for the 2008-2009 recession didn't get approved until a year after the recession began. Just took that long for it to happen. Very, very different beast, very different cause. We learned things from the global financial crisis, which I think allowed us to approach this much more efficiently. But then this is at the same time going to be a much deeper collapse.
Perfect. Thank you, Alejandra.
Right.
And Josh, do you want to add on with regards to the SAP?
Yeah, sure. With regard to the model, I would say that this time around, the model signals are not that bearish compared to in 2008 GFC, when the model equity exposure in the model went all the way down to below 10% or even some point in time 0% in equity. So what's the difference this time around and then if you remember when I talk about the 6 primary level indicators, right? Right now, 3 indicators are still favoring stocks: the OECD composite, the PMI breadth, and the central bank policy. Especially the central bank policy at the moment is very supportive for equity. However, in 2008, all indicators deteriorated and favors bonds. So that is the difference between now and then in terms of the model reaction.
Perfect. We've received a couple of questions on the same theme, and so I hope the people who have asked this question don't mind if I rephrase it a little bit. But basically, what they're asking is, do we include commodities in the allocation itself? And so I can jump on that, which is this particular strategy is built as an add-on or a bolt-on to a traditional stock bond decision. And so that it can actually go into those individual areas and invest in different geographies and sectors within both equities and fixed income. A secondary reason why we don't include commodities as a decision within this particular strategy is that we're using ETFs for liquidity purposes, for the lower expenses, and we did want to avoid any K1s being issued on the ETFs that the exchange traded products that have futures traded within them. So for this particular strategy, it does not include various commodities. But of course, there are exposures indirectly through investments in commodity-based areas. So whether it be emerging markets or both on the stocks and fixed income side. Okay, another question regarding the amount of stimulus that we're seeing globally, and basically they just want to get our thoughts on the impact of that stimulus. So I guess, Alejandra, would you mind touching on that?
Sure. So in terms of the short-term impact, it's in my opinion, just absolutely necessary. Just to kind of give you an example, even in the United States, about 50% of small businesses only have roughly less than a month to operate without any business. And so usually what happens during recessions, which are kind of driven by excesses, is that the recession sort of helps clean out the businesses that maybe shouldn't have existed to begin with. But when you have something like this where good businesses are forced to shut down, that's not good. So you need, because what you're doing is you're cleaning out good businesses that, just many of them can't survive that much longer without, with zero business. So, the stimulus is definitely necessary. It's not going to fix the problem. You can't, it won't, the health spending to some extent will help maybe, attend to the people who are sick and maybe help find some sort of immunization. But, ultimately it just sort of helps pad things. The longer term impact is what we've also had questions about, because usually, and we've seen this a lot in emerging markets, is if governments spend a whole lot, you crowd out private investment, you ultimately get higher inflation. The degree of spending in the developed world, as I showed before in that chart, is just over the top. I guess that still holds true. The question is how long will that be? Will that long term, where they start having to pay for the pain of spending too much? Will it be just a couple years? Will it be much longer than that? Just sort of depends on, if you look at within the developed world, there's no alternative to developed market treasuries, or at least at this point, or even the dollar. So it's kept the funding of this debt very, very cheap. But over the long term, there could potentially become an alternative, and this excessive spending could potentially have an impact on inflation and crowding out of private investment. But timing-wise, it's really hard to. There's so many varying opinions on what that potentially is. But in the short term, it was absolutely necessary. That economic situation we would see would have been significantly worse were it not for that.
Thank you, Alejandra. In terms of just going into some of the logistics of the model itself, we've had a few questions. One of them is in terms of the rebalance of the strategy. Josh, do you want to touch on that and how often the portfolio is rebalanced?
Yeah, sure. In our portfolio, we do monthly rebalancing. We actually look into between weekly, monthly, as well as quarterly rebalancing, and we found that weekly rebalancing would react to this kind of environment faster. However, in the normal situation, you would have a lot of whipsaw in the market that would penalize the performance quite badly. And if you talk about quarterly rebalancing, it's very slow to react. So on the balance, that's why we chose monthly rebalancing. And the return profile in terms of risk-adjusted return is also the best in terms of monthly rebalancing.
Yep. And one thing too is just if you're being tax aware, just the more turnover you have, it could have broader implications there and be a further drag on performance. And so absolutely, so all those things went into consideration, and why we use monthly as our default rebalance frequency. Some more questions just on the logistics of the model. We've had some questions on the individual ETFs and how those allocations are decided. And Josh, you touched on that before. Would you mind going back over the allocations, the technical models that allocate across the ETFs?
Right. Okay. So in summary, we have two levels of asset allocation. The first level is to determine between equity and fixed income based on the 6 indicators, the primary level indicators. And if you want to go into each individual ETF, that is a secondary level. So, for example, in equity, we look at T-score, we look at our own proprietary momentum indicators, we look at the relative strength indicators, and we look at the bow tie indicators. For the fixed income and cash, we look into MACD, distance from the exponential moving averages, and relative strength index, and the bow tie indicator. You can find this information in one of the slides later on.
Perfect. In terms of the back testing that went into the strategy, we just had some questions on that as well. How long does our back test go? What do we consider a long back test? And also a few questions on the indicators themselves. Do we feel that historical or backward-looking indicators have value going forward? So if you don't mind, Josh, I think I'm going to start on that, and then I'll turn over to you if you have additional thoughts on it. So in terms of the back testing itself, I can give you a brief overview of the NDR backtesting process, which involves our strategists working together with our research team, getting the best ideas from their what they've read in the literature. In terms of there's a back and forth there in terms of what we believe should work going forward. So we've touched on a lot of these concepts during today's presentation. Not fighting central banks, making sure you follow global trends. That's where the majority of money can be made. What our analysts then do is leverage our database, which consists of over 200 different data vendors. So we collect data from global economies, from central banks, as well as from vendors that require payment. And so we spend actually millions of dollars each year acquiring data and then processing that data. And so we have a team of data auditors based in London as well as in Florida, where our home office is based. And our team then builds different models and tests different indicators for the particular assets that we're trying to call. And we actually have proprietary software that we've built at NDR. It's based in Java with a scripting language on top of it that allows us to run different analytical techniques using different performance metrics. So we can look at the returns to indicators, risk-adjusted returns, drawdowns, as well as accuracy and consistency over different market and macro regimes. Once these indicators are then built, the models are built, we then pass this on to our index committee, which I chair. And the index committee consists of strategists, research analysts, and product specialists who review the model, provide feedback to make sure that the indicators are intuitive and that we believe they'll hold up on an ongoing basis. Once that's approved, the model is put into a production process where it runs after the data sets that go into it update. And so then we just monitor that model's performance over time. And of course, then our index committee can review it and provide feedback, but it's a continuous feedback loop. And so that's how we came up with this particular model. There's actually a lot that goes into it. It takes many months of development before we launch a model live. In terms of using some of these indicators and do backward-looking indicators work, I would say that most data sets are backward-looking. I know there are forward estimates that people provide, but sometimes you have to ask, how do they come up with their forward estimates? Usually it's looking at historical context to do so. So really, if you're looking at whether it's technical data or trailing fundamental data, it's all backward-looking. But really the key is you're looking for a weight of the evidence approach, which is when the technicals are aligning with the macro, the behavioral data, as well as the fundamental data, that can give you a strong conviction in a particular investment. And that's how this particular model works, which is, should you put the majority of your assets in stocks or bonds, and then within those areas, which sectors or geographies look most attractive? So I know that was a pretty long answer, but it's not a simple process. There's quite a bit that goes into this. Another question is, how do we choose one ETF over another for an asset class? So for example, why do we use VIG or TLT? And again, Josh, feel free to jump in. I'll give you the context for how we've come up with this at NDR. Our primary focus when picking the ETFs to represent asset classes is a couple of things. First, it's liquidity, making sure that we can invest in it and trade in and out of that particular ETF as needed. We also look at expense ratios. We want to keep costs down in terms of the model itself. But when we build the model, we actually don't build it specifically to the ETF. We build it to the index. And so actually there's a separate process that happens for picking the ETFs. We work with the ETF strategist at NDR to go through the ETFs that represent that index or proxy that index, again, that are the largest, most liquid. So we are fund family agnostic. We do not have we do not pick a particular fund family. It is based upon the size and liquidity as well as the lower expenses of those ETFs. Josh, anything you want to add on to
that? No, you have well answered the question.
Okay.
But one thing I would like to emphasize that on the ongoing basis, both Capital Capital and NDR, we work together to improve the model on ongoing basis. So we do look at new indicators that will help us with the allocation optimization process.
And we've gotten a few more questions on the same concept. What asset classes does the strategy use? And again, this is intended to be a complement or a tactical complement to a stock bond decision. So again, commodities are not part of this. REITs are not in here as well, although again, some of these equity ETFs we're using may have REITs within that decision, but usually it's a very small amount, it's a small sector allocation in there. But again, this is intended to be a stock bond decision. Alejandra, we've gotten actually multiple questions on the stimulus from the U.S. One question is, do we expect more? That chart you showed on percentage of GDP, it shows that U.S. is behind Germany and the U.K. So could we expect more stimulus from the U.S.? And then actually, I'm going to add on to that as well, because another question just came in. Do we then see this huge stimulus from the U.S. Impacting debt levels in the future and being a drag on the U.S. economy longer term?
Yeah, so first with the fiscal stimulus question, there's been talks for more. A lot of it depends on how long this lasts, but I suspect this is going to last for quite some time. Our base case right now is we expect a U-shaped recovery in the U.S. economy, which implies that things will sort of kind of get back going, but very, very slowly, and it'll take some time to get back to pre-COVID-19 levels. Perhaps we'll have to wait until there's some sort of immunization or cure, which might be over a year. So we do expect more. One thing that's been talked about, I know recently, which was fairly controversial, was they could be little things. Some of it could be removing the SALT deduction. This is the state and local tax limit that a lot of states such as New York and California were hurt quite a bit by when Trump came up with the new tax policy a couple of years ago. We could see an extension.
Alejandra, I think we've lost your audio once again.
Okay, you know what, Cynthia? Let me jump to another question while Alejandra gets back on the line there, because we've gotten some more questions. And again, just as a reminder, if you have questions, please use the questions panel on the GoToWebinar software. Alejandra, are you back? No? Okay. In terms of some more questions about the model itself, questions about drawdowns. What does the model do with regards to drawdowns? How does it think about drawdowns? How long does it take to recover from drawdowns? Those are some of the questions we've gotten with regards to drawdowns. Josh, do you want me to answer that, or would you like to answer that?
I can take this question. Okay. So if you look at the past drawdown of the models, I would say that we do experience quite a fair bit of drawdown in many occasions. However, usually by and large, the new high has always been reached within a few months after the drawdown. For example, in May 2000, in 2006, or even in 2007, 2009, you have very big drawdown in September 2008 or February 2009. But by June 2009, the strategy had made a new high, and so I would think that in general the model would take about 3 to 9 months to reach new high, based on the past experience. Anything you want to ask? You want to add on, Brian?
No, I guess you've given great historical context there. I guess the one thing I'll add is when we were building this particular model, each model has a different purpose. And again, this particular model is intended to be very tactical. We actually, one of the key performance measures we evaluated when building this model was drawdowns relative to the benchmark. And so that was something that was one of the things we looked at to avoid those bigger losses. So it wasn't just return focused, it was risk focused in particular. Let's see, I just want to check, Alejandra, are you back online? It looks like she got cut off.
Okay?
Actually, yes, there you are.
Okay,
Yep.
I've been online the whole time. My voice is cutting off.
No problem. So I guess you were talking about the stimulus for the U.S. and longer term implications. Would you mind continuing on with that?
Yeah, no worries. I don't know what got cut off initially, but yes, we do expect more fiscal stimulus, especially as this gets dragged out, because our base case right now is
Oh, Alejandra, it's cut off again. Sorry about that. You know what? Let me jump to another question that came in. We're getting some questions just about fundamentals more broadly. In particular, what kind of multiple expansion would we expect here, given the economic implications? And I was actually just reading one of our strategists, Ed Clissold, our chief U.S. strategist, just put out some work just studying earnings during historical recessions, as well as the impact on multiples. And so I'll give you some statistics on that. Within the S&P 500, usually during a recessionary bear market, GAAP earnings tend to decline about an average of 17%. So it's 17% during recessions. But one of the things to note is that the earnings cycle doesn't necessarily align with the market cycle. And so usually the earnings actually peak about 6 months before the recession starts and then trough about 4 months after recession ends. And so if you look at a peak to trough decline in earnings broadly, it's about 25% around recessions historically. And so in terms of the overall PE multiple, usually what happens is it actually rises during recessions because earnings fall greater than the market itself. And so the PE multiple typically rises about 11 points historically, on average from about 14 times to 25 times. So that's just to give you some context historically of how earnings and valuations have been impacted historically during recessions. Let's see. Just trying to see if there are any other questions in here. Oh, Josh, actually, there's a question. I think you touched on this during the call, but we've gotten some questions just on the asset allocation strategy itself and how it's reacted during this year, with the plunge in the markets due to COVID-19. Would you mind touching on that?
Yeah, sure. Okay. The model actually has, from second half of 2019 all the way to January 2020, the model actually allocated about 72% in equity all along. And in February, the model reduced equity exposure to 55%, and now 42% in March. And in terms of equity, allocation in the small cap in IFA international equity has been reduced significantly lately, and we don't have any exposure in EM equity or emerging market equity. And in fixed income, I also noticed that the model turned more expensive, especially to move into Treasury. So the TLT, the allocation to TLT, the US long-term Treasury has increased. And SHY, the allocation in February was 2.2, has increased all the way to 22.2% in March. This is SHY, the short-term US Treasury ETF, and also BNDX International Treasury received allocation in March, and we don't hold any JUNG, the US High Yield Corporate ETF, or EMB, the Emerging Market Bonds at the moment. So I would say that the model has as expected, become more defensive, reduce equity exposure, increase bond exposure, move into large cap, move into treasuries, but not that very bearish compared to what we saw in 2008 or even 2014 or 15 period, 2015 or 16 period.
Perfect. Thank you, Josh. And a follow-up question here, which is, are we worried about, just given how connected the entire world is, could correlations rise and infect all these ETFs that we've chosen at the same time in a negative manner? And I guess, do you mind if I start and then you can add on to that?
Sure.
So it's a really good question, right? Which is, the world has become more interconnected. But there's a couple of things that happen here. One is that we do have the ability to go into cash within the strategy. So, and that's what we've seen historically during the deep recession and the global financial crisis. The equity allocation dropped pretty dramatically, and we saw a sizable allocation into cash. The other things, especially during these past couple of months, we haven't seen that cash raise, but the allocation has gone into longer and shorter term U.S. Treasuries, and they've been very strong performers. So the beauty of having the two models, the first model is it gives you that conviction on the weight of the evidence on stocks versus bonds. But then within each of those asset classes, we have the technical models that can reallocate away, in particular into cash, if the asset classes are all falling simultaneously. Josh, anything you want to add on to that?
Yeah, sure. I saw one of the similar question asking the correlation has increased globally, and what the point, or see any value being invested in different asset classes or stock market, U.S. international versus emerging market. I would think that as I mentioned, asset allocation is key in the long term. My experience is that especially in equity asset allocation between the U.S., the rest of the world, or emerging market, European equities, all this matter most. Even before you pick the right stock, pick the right sector. For example, it's very important to, before the global financial crisis, emerging market did very well versus, for example, developed market or the U.S. But after the global financial crisis, U.S. has outperformed the rest of the world significantly. So in the long run, asset allocation between different asset classes as well as between different regions is very important. Even in the short term, you might see strong correlation, everything being crashed at the same time, for example. But in the long run, they do matter to optimize return. Yeah.
Then I know we're over the hour mark. I guess there's two last questions here. One is, why not have tips on the fixed income side for an inflation hedge? I can start to answer that. Remember, it's a two-step process that chooses between stocks and bonds. And so once that allocation is decided, that second level model comes in to allocate within each of those asset classes. And so if you look at the indicators at that top level, you're looking at things such as the PMIs, Baltic Dry Index. And so if you are seeing a more inflationary environment, chances are those are going to be favoring stocks over bonds anyway. And so most of the allocation is going to go into the stock side. And then the technical model will pick up which of the areas are benefiting best from that particular environment. And so having tips on the fixed income side, it sounds like a good inflation hedge, but chances are the fixed income portion probably wouldn't get as much allocation in such an environment. And then the last question we've gotten in here are asking for statistics, things like the returns, drawdowns, Sharpe ratios. Great question. We cannot answer that question on this call. However, as you see up on the screen right now, we do have the contact information, so you can reach out to Covenant Capital directly to get that information, and we encourage you to do so. So that's all the time we have for questions today. We really appreciate everyone jumping on the line, listening to our remarks. The questions you've asked have been fantastic, and we hope you have a great day.
Well, Brian,
thank you, everyone.
Alejandra, Brian, Alejandra, and Josh, thank you so much for today's presentation. Also want to thank and reiterate what Brian just said. Terrific questions from the audience here today. I would like to remind everyone we have been recording today's session, and each of you will get a direct link to today's recorded playback soon after the webinar ends. So if you do want to access the information and come back and review the concepts discussed, simply watch your inbox later on today. So with that, I would like to thank Covenant Capital for today's presentation, for organizing our presentation, and also thank Ned Davis Research. By the way, I do want you to be aware that NDR Research is available to Interactive Broker clients through the Trader Workstation. I'll be including a link where you can find more information in today's follow-up. So with that, we are going to conclude today's session. By the way, do want you to be aware in the handout screen, if you'd like a copy of today's presentation, you can download it directly before we do end our session here today. So with that, once again, thanks to all for your participation and have a great rest of your day. Watch your inbox. We'll be following up with you as soon as today's recording does become available. Thanks, everyone. Have a great rest of your day. You can exit using the X in the upper right-hand corner of the screen. Have a good one, all, and thank you.